Early retirement is a solvable mathematical equation. By focusing on specific variables, we calculate a predictable path to leaving the workforce decades early. The hurdle most people hit is something called lifestyle creep. As a salary goes up, spending tends to go up right alongside it. Our expenses naturally expand to consume the new income, which constantly pushes the finish line for retirement further out of reach. To solve this, we can look to the Trinity study and financial planner William Bengen, who established the 4% safe withdrawal rate in 1994. Based on historical market data, he calculated the specific percentage you can continuously pull from an investment portfolio each year without it depleting. That withdrawal rate dictates the primary formula for financial independence. Take your annual expenses and multiply them by 25 to get your target portfolio size. It's based entirely on spending. If you spend $40,000 a year, multiplied by 25, your target is $1 million. Because this target relies entirely on expenses rather than income, you hold the levers. Anyone can manipulate their daily financial variables to reach financial freedom long before age 65. Before any wealth can be accumulated in this equation, you have to stop the mathematical bleeding. High-interest consumer debt creates compounding losses that actively work against you every single month. There are two main strategies to clear it out. The debt snowball strategy targets your smallest balances first. Paying those off quickly creates psychological momentum and gives you immediate behavioral wins. The debt avalanche strategy goes in the opposite direction. You prioritize the debt with the highest interest rates first. This is the mathematically optimal path to save the maximum amount of money over time. Regardless of which method you choose, eliminating those negative integers is mandatory to free up cash flow for the equation's growth variable. With your cash flow freed from debt, you put it to work. You take that surplus and buy diversified, appreciating assets. To project how fast those assets will grow, investors use the rule of 72. You simply divide the number 72 by your expected rate of return, and it tells you approximately how many years it will take for your investment to double in value. This chart shows the value of monthly savings over 30 years at different interest rates. The bottom line tracks money sitting with no interest, but the top purple line tracks an 8% return. Over decades, the gap stretches into hundreds of thousands of dollars. Because interest is paid on previously earned interest, the growth becomes exponential. On this chart, the 8% line stays relatively close to the others for the first 15 years, but by year 30, it has curved into a steep parabolic climb. This shape proves that the time your money spends compounding is the most powerful variable in the equation. But there is one final lever in this optimization engine: your savings rate. This is simply the gap between what you earn and what you spend. The math of expense reduction is extremely aggressive. Permanently cutting just $100 a month in living expenses mathematically reduces your total target by $30,000. This creates a massive time compression effect. A standard 10% savings rate means it will take roughly 40 years to reach your goal. But increase that savings rate to 50%, and you compress a 4-decade working career into roughly 17 years. Reducing your expenses acts as a double-edged sword in the equation. It simultaneously creates more cash to invest today, while permanently lowering the total amount of money required to finish the race. To successfully execute the formula, you have to remove human error. Automating your savings and investments allows the math to run in the background. It enforces consistency and prevents lifestyle creep before it even starts. And solving this equation doesn't mean you have to quit working entirely. It unlocks distinct variants. You can choose Coast Fire, where you invest enough early on to let compound interest carry you the rest of the way, or Barista Fire, where you work part-time in a low-stress job just to cover current expenses and health benefits. This extreme optimization approach has been championed by pioneers of the FIRE movement, financial independence, retire early. They've proven that maintaining a highly optimized, frugal baseline yields a rich, deeply liberated life. Financial freedom is a calculated target. Every dollar diverted from a budget into an investment buys back a specific amount of time, transforming today's savings into months and years of absolute unrestricted freedom.